You moved to Florida. You changed your domicile. You filed the declaration, and you assumed the state filing chapter of your life was finally over. For most people, it is not, and the reason is that residency and sourcing are two different questions. A non-resident state tax return is the form a state requires when you receive income from inside its borders but live somewhere else. Establishing Florida domicile ends resident taxation in the state you left. It does not end non-resident taxation. Here is the part that surprises people. The part-year return you file in the year of your move happens once. A non-resident return repeats every year that the source income continues. So what counts as source income? Wages for days physically worked in that state. Rent from real property located there. Gain on the sale of that property. Income from a business carried on there. And one that catches sellers. Payments under a covenant not to compete. Because New York treats income related to a business previously carried on in the state as New York source income. What is out of reach matters just as much. Interest, dividends, and gains on marketable securities are generally excluded because intangible property follows you, unless it is employed in a business carried on in that state. Qualifying pension and retirement income is protected by federal law under Title IV, Section 114. Now the mechanic that almost nobody explains. Most states do not simply apply their rate schedule to your in-state income. The Form IT-203 instructions tell New York filers to calculate a base tax as if you were a full-year resident, and then apportion it. California reaches the same place with an effective rate, the tax on total taxable income, divided by total taxable income. That has a consequence worth sitting with. The base is your entire income. So the income you earn in Florida, which Florida never taxes, still climbs the graduated brackets and raises the effective rate applied to the slice that other state can reach. A better year in Naples can raise the tax on an unchanged rental up north. And there is no credit to soften it. The credit for taxes paid to another state is claimed by residents on a resident return. In Comptroller versus Wynn, the Supreme Court held in 2015 that a state failing to credit tax paid elsewhere violates the Dormant Commerce Clause. But that protection is a duty owed by your resident state. Florida levies no income tax on natural persons, so there is no resident return and nothing for a credit to reduce. The tax becomes an absolute cost. One more practical point. The income that survives a move often arrives with no withholding attached. Rent does not withhold. Partnership distributions do not withhold. That generally means quarterly estimated payments to the source state, and property sales carry their own withholding at closing on Form IT-2663 in New York and Form 593 in California. If a state still sources income to you, file. An unfiled year generally never starts the limitations clock, and a question about source income has a way of becoming a question about whether your move was effective at all.